Today I'm breaking down 3 key confirmations that tell us whether a supply and demand zone is actually high probability, and showing you real-time examples of how these confluences will change how you're trading in the market every single day. Throughout my entire documented journey, these 3 confirmations have proven to be the reason that I'm actually profitable to this day, and if you ignore these things, then you're probably taking a lot of unnecessary losses and leaving a lot of money on the table that real investors are taking advantage of. So let's just get into confirmation number 1. There are several reasons why movement before our supply and demand zone is crucial to whether it will hold or not, but more specifically, movement directly down to my zone is a complete make or break for my setups. So let's take a look at what we generally like to see versus what we don't like to see coming towards our zones. Starting off with what's ideal for us, the best possible scenario is that we move in a directly straight line towards our zones. So as you can see on both of these examples on screen, as we are moving towards our zones, we are seeing very clear price action, very few opposing candles, and then reacting from our zones. So why is this? Well, we know price will always move in swings, so at some point price will definitely need to see a retracement. We know price isn't just going to move in a straight line forever, so if we've been moving bullish for some time now, chances are we're going to need to retrace soon. But how do we know exactly where price will do this? Well, we find an area of interest for investors and institutions to buy at, aka our supply and demand zones. And this just adds a whole extra layer on why this zone is likely to win. We know this is a great area for investors to buy at because, we've moved super bullish from there before, so it's seen as a key area in their eyes. It's also a great price for them because we're no longer at the top of this move, but instead we've come down and reached, let's say, maybe a 30 pip better price, which to these investors is worth tens of millions. And we know price now needs to retrace because we've been moving bullish for some time now, and that's just basic principles of the market. We know price will never just move in a straight line forever, so when banks, investors and institutions start buying, the whole market will move with it, and we're just piggybacking off that to get an amazing risk to reward. So now when we see zones like these, we'll be far more confident to take a position. But what type of movement don't we like to see? Well, it'd pretty much just be the opposite type of price action. The type of price action that is not convincing to say that we will likely continue in the direction of our supply and demand zone. So why is this not convincing? Well, if you take a look at the breaks of structure here, I know there's a lot, but if you actually look at each one carefully, we have failed to break every single high here, and we easily broke past every single low. Same with the one over here. We are breaking every single high and failing at every single low. And what do we know this as? Well, trends. If we are even having a short-term uptrend towards a supply zone or a short-term downtrend towards our demand zone, this is never going to be ideal. Why would we ever be looking to buy into bearish market structure? Or vice versa, why would we ever be looking to sell in structure like this? We ideally want clear movement, that way we know price is in need of a retracement. So now looking at a real example of how this was effective during a real trade that I took in the live markets, we can see all the principles playing out to our advantage. We've continued to look bullish this whole way, we're showing no bearish intent. We need to retrace because we've just moved in a straight line down for like 50 pips. We know price isn't just going to continue down. Also, that would be breaking a low, and in a bullish market, which this was in, we're likely not going to be breaking those major lows. So basically, everything is against it continuing down from this point. So this is an amazing area to buy at. And on top of that, we've created a clear path to follow as we move towards TP. If we had created a bunch of swings on the way down, we know price is likely to react from those types of structure, but instead the only thing to react from is really these highs because it's just liquidity. So our TP is minimum going to be at these highs, which is a great risk to reward. But also if we had come down with bearish market structure here, you can understand why that's not a good sign for us to see. Generally, price will maybe get a small reaction, give your entry model, and then just continue down and just shrivel out of volume into your stop loss. But on to confirmation number 2, zone placement. Most supply and demand traders are constantly getting faked out, taking loads of setups because they don't know which ones are the highest quality. They'll constantly get confused if there's a bunch of zones on a pair, thinking which ones should I take? And this will absolutely destroy your otherwise good win rate if you can't decipher this. So that's where this comes into play. If we have a bunch of supply zones created on our move down just like this, which ones should we be looking to take? All 4 of these look good, so why shouldn't I just take all 4 as they come to entry? Well, it's because we can decipher the best zones here. So what do we know about the bottom zone of this move? Well, it's good because we know that price will frequently make these sort of continuations where it doesn't want to make a massive move all the way down, but price obviously needs to make these sort of retracements. Like I said, it's never going to move in a straight line. So it will just make these kind of small swings where investors are just getting in at the bottom and pushing the markets back up. this is an obvious bullish continuation, and we can take advantage of these by taking these zones. They're good in continuation type structures. We're still reaching a better price for investors because they're selling up here instead of down here. And often price doesn't always want to commit to coming all the way up here. We know that. It's not always going to come all the way to the top of structure because we're just continuing bearish. We don't want to rule out these zones just because, I mean, we'd be missing out on a lot of profit. So what about the top zone? Well, these can also be good because we know price often does make these large swings. Price will frequently come to the top of structure and react as if it's some kind of resistance. As you can see here, we reach the highest point of the area and we drop. We reach the highest point of the area and we drop. It continuously happens throughout the market because the top of each major swing will be the best price for investors to enter at without completely changing direction. In this example, they're not going to wait till up here to enter because then we've broken this high. That's where breakout traders, etc., they're all going to be entering there, so they don't want to sell against those people. But they're also likely not going to enter down here because, like I said earlier, those pips are worth tens of millions to these investors, institutions and banks. So it just makes sense for them to enter at the top of each move. And on top of that, price clearly had something about these areas that made them dump so heavily before. So investors will see these as key areas and be looking to sell from here again. As we know, the history of the market repeats itself. That's what strategies are completely built off. Just the history of the market repeating itself over and over again. That's how we can be profitable, just by looking at these patterns and capitalizing off them. So now we know that both of these zones are fine to trade off. They have different advantages and can be used well in varying circumstances. So what about the middle zones? Well, generally these are ones that I tend to try and avoid. You have to get into the mind of an investor and think where they're entering at, because once again, all we're trying to do with supply and demand is trying to get in on the moves created by these large capital holders, because they're the ones moving the markets. We're not going to do shit. We're just piggybacking off of them. Now, these zones are completely okay to take sometimes because they will often be the highest quality zone in structure. For example, this zone right here has far better liquidity than this zone down here. So I might see this zone and think it's much better than the bottom one. But generally, investors have no reason to be buying at these zones over the top or bottom zone. They offer no particular benefit over the others, and most of the time will just fall through to go to the top zone. So how I usually go about it is I wait for my entry model on the bottom zone. If it's high quality, of course. If it's low quality, then it's not even counted as a zone to me. And if it falls through, then I wait for the top zone. Simply because if price isn't going to make a quick continuation off this bottom zone, then it's likely going to go to this top zone because investors will be waiting for the best price. These zones in the middle don't offer any real benefit. After all, when you see structure looking like this, how often are you expecting price to just come down here and fuck off? Like, generally you would expect it to come down to here or to here, and in this example it obviously made more of a continuation off the top zone. And in the original example here, it went off the top zone, but I low-key could not find the example I used for this, so yeah, I couldn't find it. You just kind of gotta trust me there. But on to confirmation number 3, the volume profile at our zones is extremely important to whether a zone is likely to win or not. Now, I'm not going to go as in depth on this as the other ones because it's pretty simple, but if your zone doesn't get a convincing rejection, that simply means that investors ain't buying there, gang. Like, there is nothing you can excuse for taking a setup that didn't get a good reaction from the zone, because there's no one buying there. You're not piggybacking off of anyone. You're just hoping you move the market yourself. You'll see setups all throughout the day or week or even month, and there is no reason to be forcing yourself to take a setup where investors are clearly not interested. I mean, you can see right here in this example, we have our zone drawn out, and whilst we got a good enough rejection to not close inside the zone, which is, you know, one of my rules to make a valid setup, we still barely came into the zone, and we have a lot of selling power shown by that massive upper wick on that candle, and this will almost always lead to price just immediately taking you out or slowly fizzling out of volume until it reaches stop loss. So even though we have a rule saying that price can't close inside our zone, getting that extra confirmation of seeing an insane rejection will only ever increase your win rate. Sometimes it may make your risk to reward a little bit worse, I know, but trust me, for your psychology, that win rate is so important, and it's worth just waiting for that next setup to get a better reaction. Anyway, I hope you got some value out of this. Like and subscribe on that if you did. Go back test all the information that I gave you today, of course. That's what's most important, that you are understanding the information I'm feeding you. And if you want way more information like this, check out the VIP Discord. If not, you don't have to. But yeah, peace.